Good evening. I am Bonita O'Banion.
I am Ryan Mack.
I am Reginald Israel. And I am Craig Flemings.
Good afternoon. We are Israel LLC, and today we will be speaking about Sandisk Corporation. Sandisk was incorporated in Delaware in the year 1988. They are the leading manufacturer of flash memory storage solutions. They produce items such as microchips and SSD chips, and these items can be found in items such as smartphones, tablets, laptops, and other mobile devices. Based on the industry that Sandisk is in, we decided to speak to you all about the 4 accounts we believe will have the most significant impact on Sandisk financial statements, should they be misstated. They are accounts receivable, inventory, revenues, and direct costs. We decided on these accounts because of the high inherent risk implied within these accounts, as well as the great potential for misstatements and the effects these will have on financial statements should ineffective controls be in place.
Again, I am Craig Flemings, and I will be reviewing the inventory account. When assessing the inventory account, we gave valuation a medium risk because of the possibility of obsolescence. It is important to ensure that the value of inventory correctly reflects its current fair value. When reviewing the attribute risk, there was a high volume of transactions which increased susceptibility of misstatements for this account. The large amount of transactions gives the employees of the company more opportunity to record inventory at an incorrect amount. The entity level controls we chose are ELC 06, ELC 08, ELC 10, and ELC 12 because it is important for inventory to actually be recorded in the proper period. ELC 06 was the failed control. The residual risk for completeness is at a high ranking because this control is to verify that period and close procedures have been performed. Failure of this control increases the residual risk of the inventory account not being completed. The process level control we choose to implement is GA02 because this control ensures the debt and credit amount are proper and verifies that all source accounts are captured, thus mitigating the remaining residual risk of completeness.
When assessing accounts receivable, the primary risk is that receivables will be overstated. This is because either receivables have been overstated or the allowance for uncollectible accounts has been understated. With this inherent nature, the risk of misstatement due to existence and valuation is high. To obtain an understanding of the controls in place to mitigate this risk, we, the auditors, could conduct a walkthrough of the AR department to observe the processing of the transactions and acquire upon employees within the department for step-by-step procedures. We can also view client and internal documents for evidence of the performed procedures. And now, upon gathering this information of the controls, we then document our understanding and then move forward with evaluating these controls through substantive testing of accounts receivable. Upon gaining knowledge of the controls, we document our understanding and then move toward evaluating these controls through substantive testing of the accounts receivable. We do this by obtaining and evaluating an aging of accounts receivable. We would agree this detail to the control account balance to ensure that all AR transactions are accounted for. We could also pull a sample of customers from the AR listing and get confirmation to ensure that these customers actually exist and ensure that accounts have been properly recorded. Consideration should also be given to the possibility of some of the amounts being pertaining to related parties. In order to analyze these or to test for those amounts being related to related parties, we could review the SEC filings and also do inquiries with the management. And once we find out that there are some related party transactions, we can communicate the names of the related parties to all of our audit team members so that they can be alerted for these related party transactions. As it relates to the entity level controls, we selected 4 and 2 of which failed, causing a high residual risk for the assertion as it relates to valuation. So to mitigate that remaining residual risk, we selected a process level control, specifically AR07, because this control is an approval process for the valuation of accounts receivable for the quarterly review of the allowance for uncollectible accounts. This would effectively lower the residual risk for completeness and also valuation.
And once again, I am Reginald Israel, and I'm going to be speaking of the revenue account. The revenue account, it has a high inherent risk, mainly because it's highly susceptible to misstatement, because management would try to overstate revenue to look more profitable to its stakeholders and potential investors. Because AR is an intangible asset, it can be easily manipulated, and this AR will be used to inflate revenues, which will overstate net income. Upon conducting our analytical procedures on Sandisk, we noticed a decrease of 10.77% from 2011 to 2012. But from 2012 to 2013, it was an increase of 22.12%. The drop in the revenue in 2011 can mean that Sandisk had a not so prosperous year in comparison to 2011, because 2013 it came back. In 2013, revenues increased. This can explain the fluctuation in growth and regression. Because accounts receivable is an intangible asset, it can be easily manipulated. It can be easily manipulated to inflate revenues, so that net income can be overstated. So when we look at the revenues account, the management and financial assertions that had the main concern will be existence. Materiality, transaction volume, and susceptibility to fraud are the attribute risks that had a high level of potential misstatement or control failures. To mitigate the potential misstatements or control failures, the ELC that we chose is the entry level controls that we chose will be ELC 1, 2, 5, and 8. We believe these controls should mitigate the high inherent risk of revenue account, because it ensures the supporting documents are available, as well as receiving approval from top management. After unlocking the results of our controls, out of the 4 controls we chose, only 1 control was ineffective, which is ELC02. This control, ELC02, it mitigates the valuation of AR. So because of this, by this control being ineffective, it had no residual risk. It had no residual risk on the existence on revenues. Because of the failure of the entity level control, the process level control we chose is REO2. This control will ensure that all recorded sales for the month have a higher possibility of being valid, because senior accountants will review revenues. So this will mitigate the assertion of existence.
Once again, I am Bonita Obanian, and I will be talking about direct costs. The inherent risk for this account is high. It is high because the cost that goes into producing inventory. I am Bonita Obanian, and I will be talking about direct costs. The inherent risk for this account is high. It is high because the cost that goes into producing inventory. There are many schemes involving inventory that can occur to misstate it, and thus mistake direct costs. The cost associated with producing some of Sandisk products is high, but a firm may try to understate these costs in order to increase their gross margin and thus their net income. Without any internal controls to mitigate the misstatement of this account, employees will definitely try to understate it. The management assertion we believe most affects or applies to this account is completeness. We believe this to be the case because in order to make the firm seem more profitable, a firm will try to understate the direct costs. Therefore, transactions that directly affect direct costs that should have been included may be left out in order to lower their costs. So management should ensure that all costs are included in this account, and therefore the completeness assertion will be accounted for. The potential for misstatement is high for this account as it relates to materiality, because if the amount were to be material, the account would be materially misstated, and this would have a negative impact on the financial statements. The entity level controls we gave to this account did not mitigate the inherent risk. so therefore the residual risk for completeness remained high. So we apply process level control GA03, which ensures all amounts were properly allocated. We believe this control will help mitigate the risk of this account being understated because the person performing the control would have to match revenues with related expenses. They would have to follow GAAP by engaging in the matching principle. Once they match the two, there's no way any expense can be left out. And therefore, direct costs will be properly accounted for and thus mitigating the remaining residual risk for completeness.